All right, let's dive right in. If you really look closely at the dollar in your wallet, you'll realize it's currently losing a battle. It's a completely silent battle. A slow one for sure, but man, is it inevitable. Every single morning you wake up, your dollar buys just slightly less than it did the day before. It usually isn't super dramatic or obvious in the moment, right? But it's just enough that you feel it in your gut, even if you can't quite put your finger on why. Just think back to a grocery cart from 2020, literally overflowing with food for $100. Now picture that exact same cart in 2026, half empty, using that exact same $100 bill. That is a massive, completely visceral drop in purchasing power.
Welcome to This Explainer, where we're going to unpack exactly what is happening to your money. Because look, here's the absolute truth of the matter. This loss of purchasing power, it's not random. It's definitely not some accident. The value of your dollar is controlled deliberately and systematically every single day. So today, we're going to expose exactly how that value is determined and, more importantly, why it just keeps falling. To get there, here's our roadmap for today. Section 1, the silent dollar drain. Section 2, the 5 macro forces. Section 3, 4 strategies for protection. And finally, Section 4, the prepared mindset. The stakes here are incredibly high, so let's just jump straight into it. Section 1, the silent dollar drain. Okay, so the absolute biggest myth we need to dispel right out of the gate is that the dollar's value just kind of floats freely on its own, like a leaf blowing in the wind. It does not float randomly. Every major movement in the dollar's value has a very specific cause, a specific decision, usually made by a specific group of people. And look, understanding this isn't just some boring academic exercise for economists. It directly dictates the 4 major pillars of your everyday financial life. Seriously, everything in your financial life is downstream from the dollar's value. When it drops, the ripple effects are huge. It pushes your mortgage rate higher. It makes your grocery prices spike. It shrinks the real, actual value of your retirement savings. It even increases the likelihood of layoffs, directly threatening your job security. Section 2, the 5 macro forces. So, knowing that your purchasing power is falling, how exactly is that value determined in the first place? Well, the mystery ends right here. The dollar is driven by 5 distinct macroeconomic forces. Think of them as the engine running behind the scenes, working simultaneously every single day to control exactly what your money is worth. We're looking at interest rates, the inflation rate, the national debt, the trade balance, and global confidence. Let's break these down one by one because, quite frankly, this is the exact formula that controls your financial future. Force number 1, interest rates. Make no mistake, this is the most powerful lever of them all. When the Federal Reserve raises interest rates, the dollar's value goes up. Why? Well, it's actually pretty straightforward. Higher rates act like a giant magnet. They attract foreign investors who are hunting for better returns on U.S. assets. All that foreign capital flows in, and boom, the dollar strengthens. Conversely, when the Fed cuts rates, the dollar weakens. The U.S. suddenly becomes way less attractive to those foreign investors. Capital flows out, and your purchasing power drops. In 2026, the Fed is basically walking a tightrope, desperately trying to navigate between fighting inflation on one side and avoiding a full-blown recession on the other. And remember, every single careful step they take on that tightrope literally moves your dollar. Force 2 is the inflation rate. The rule here is simple, it's brutal, and it's incredibly consistent. High inflation means the dollar is simply worth less. Now, the Federal Reserve's stated target for inflation is 2% annually. Sounds reasonable, right? However, the current rate in 2026 is still running pretty hot above that target. What this means in plain English is that prices are rising faster than wages. Your real purchasing power is shrinking. It's honestly like an ice block melting in the sun. Even if your paycheck number stays exactly the same, you're effectively earning less every single month, just because those dollars don't stretch nearly as far as they used to. Then we hit force 3, the national debt level. $35 trillion. Seriously, just take a second to absorb the sheer scale of that number. And the crazy part, it's still climbing. The crucial point here is that every single dollar of that massive debt is essentially a claim on future dollar value. Think of it like a giant set of scales. On one side, you have a strong dollar, but on the other side, we just keep dropping these trillion-dollar debt blocks. Eventually, when debt grows way faster than the economy itself, creditors start to get spooked about America's ability to actually repay it all. When that happens, confidence falls, and the dollar's value, it falls right alongside it. All right, let's move on to force 4 and see how this all builds up. The trade balance. When America imports more goods than it exports, more dollars flow out of the country than flow back in. And here's a wild fact. America has run a trade deficit every single year since 1975. It's an unbroken, relentless streak spanning decades, all the way right up to 2026. This really matters because
When there are more and more dollars circulating globally, it dilutes the overall pool. Simple supply and demand, right? Each individual dollar becomes worth just a little bit less.
And finally, we arrive at Force 5, global confidence. This is perhaps the most fragile force of the entire bunch. The dollar's absolute greatest source of strength is its status as the world's reserve currency. Globally, oil is priced in dollars, trade settles in dollars, countries hold dollars in their central bank reserves. It's the standard. But right now, that foundation is actively cracking. We're seeing BRICS nations aggressively building payment alternatives. We see Saudi Arabia accepting the yuan for oil. We're seeing Russia, China, and India settling major, multi-billion-dollar international trades without even touching the US dollar. When this global confidence falls, the dollar falls with it. And according to the data from our sources, that confidence is taking a very real hit right now.
Section 3. 4 strategies for protection. So we've outlined the problem and we know the macro forces driving it. But what do you actually do when the currency you earn is worth less every single year? Well, you stop storing your value in it. Enter the wealth preservation playbook. See, wealthy investors don't just sit back and watch their purchasing power evaporate. They actively convert their cash. They rely on 4 key strategies: owning hard assets, holding physical gold, investing internationally, and dollar cost averaging. Let's walk through exactly how each of these acts as a financial shield for your portfolio.
Strategy 1 is to own hard assets. We're talking about assets that are priced in dollars but are backed by real tangible value, things like real estate, stocks, and commodities. Think of this dynamic like a seesaw. When the dollar weakens and goes down, the dollar price of these hard assets automatically goes up. It's a built-in automatic hedge. By holding these, you aren't just losing purchasing power, you actually keep pace with the falling dollar, or in many cases, you even gain. Now look at strategy 2, holding physical gold. Gold has successfully preserved purchasing power for roughly 5,000 years, 5 millennia. Meanwhile, the fiat US dollar, which was created in 1913, has already lost 97% of its value in just over a single century. Literally every currency that has ever tried to compete with gold has lost. The strategy here isn't necessarily about making some massive get-rich-quick profit. It's entirely about protection. Allocating 5 to 10% of a portfolio into gold is a classic, time-tested wealth preservation strategy against a melting currency. Strategy 3 is all about investing internationally. It really boils down to a very simple equation. Total dollar dependency equals total dollar risk. Think about it. If your entire financial life is tied to just one currency, you are going to take the full brunt of its fall. By spreading your investments across foreign assets that are priced in stronger currencies, you diversify that risk away. So if the US dollar falls, those foreign assets actually gain value when you eventually convert them back. And strategy 4 brings us to the power of consistency, dollar cost averaging. This is where you consistently invest into broad index funds, smoothing out all those crazy market fluctuations over time. To put that into perspective, the S&P 500 has averaged over a 10% annual return for 50 years. That upward long-term trend line cuts straight through the noise of any short-term dollar crises. Consistent monthly investing, completely regardless of whether the dollar feels strong or weak that particular month, is how you build real lasting wealth over time. Section 4, the prepared mindset. Okay, so we have the strategies, but there is one final, absolutely crucial piece to this entire puzzle, the mental shift required to actually execute them. Here is what most people miss completely. A weakening dollar is not just a threat. For the informed, it's actually a tremendous opportunity. The unprepared average person reads the headline, "Dollar weakens." They panic, they scramble, and ultimately they suffer. They're caught out in the storm without an umbrella. But the informed investor? They read the exact same headline, stay completely calm, and just watch their pre-purchased assets rise in value. They position themselves in advance. They bought real assets when confidence was high. So when confidence inevitably falls, they are perfectly sheltered. You really don't need a crystal ball to survive this. You just need a diversified, asset-heavy portfolio built before the storm hits, not during it. So, to bring this all together, the dollar's value just isn't a mystery anymore. It's a very definable formula. Just keep your eyes locked on these 5 indicators: interest rates, inflation, the national debt, the trade balance, and global confidence. If you watch these 5 forces, you will always have a clear lens on exactly where the dollar is heading, ensuring you are never caught unprepared. Ultimately, the underlying mechanics of the global economy dictate that the dollar is just going to keep moving. Those macro forces are constantly in motion, every single day. So the only real question left for you is this: the dollar is going to keep moving. Are you going to step up and move with it, or are you just going to wait around to be moved by it?